Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I just want to share with you guys today 5 different companies that are dividend growth companies that they beat the market over the last 15 years. And the reason I want to share this video with you guys is just to kind of give you an idea of the fact that yes, we're in a volatile market. Things are not great at the moment. The earnings season has started, and that is also adding to the pressure of investors buying stocks and so on. And the fact that the tariff situation has not been sorted, and it's not going to be sorted in the next 90 days or whatever days left. And there's a lot going on. So those uncertainties are not good for the stock market. And what we try to do as a long-term investors is genuinely think about that long-term goal. Now, if you were bought these companies, 15 years ago, I want to show you if you invested £10,000 in any of these companies in the last 15 years, how much you would have actually been up. And some of the returns are absolutely ridiculous. So every single one of these companies beat the market. And I'm going to show you also what these companies have done, like where they are now in terms of valuations and so on. I'll give you a little bit of information about each one of them. So yeah, let's get started. And if you are, if you stay with me till the end of the video, I'm also going to do some buying today because I do have £253 that I need to invest in this week. Some of that came from dividends, some of that came from money that I've added to the portfolio. So yeah, we'll do that inshallah at the end of the video. But before we get started in the entire thing, I just want to just quickly show you there is, like I said, the earnings season have already started. There's a lot going on. Monday has now gone. Tuesday, basically, we are here today. UPS reported they beat basically top line, bottom line. Not great, but it's basically decent enough to keep the company going in the next whatever. Margins have slightly improved, so we'll see how that goes. Visa is reporting today after the basically market closes. What else is reporting? Tomorrow we've got ADP that's reporting, another company that I own. After the close tomorrow, we've got Qualcomm that's reporting. Company that I was interested in, CP, basically is also reporting. And then basically at Thursday, we've got Eli Lilly that's reporting. We've got Mastercard, which one basically a company that I own in this portfolio. And then a couple of the big boys are reporting to Thursday after the close as well, which will be interesting to see. Plus the oil companies on Friday. So there's a lot going on right now. So you might see, for example, if Visa reports a terrible earnings tonight, then it can affect Mastercard because they are kind of go hand in hand. Whenever one goes up, the other one kind of follows in that direction, sort of. So we will see what happens. But again, like I've always said, I've used this time of year as an opportunity to add to companies that I own. And that's exactly what we're going to do. There's a company that has come down quite a bit, not just for earnings reasons, but also the overall market has come down, and I'm going to share that with you guys at the end of the video. Now let's get started with the first company. And the first company we're going to talk about today is Home Depot. Home Depot is one of those companies that's been around for a very long time. A year to date is actually down about 7%, and for that reason I think it's becoming a little bit more interesting for me. As you can see, the 52-week low for this company was $323 per share. Right now it's about $360 per share. The height basically for this company was almost $440 per share. I do think it's still a little bit overvalued, and I'll share with you guys in a second a little bit more details about this. But you can pause the video and have a look at how many strong buys and all of that we have. But we've got about 19% upside from where we are right now with this company. Now what I'm going to do is, in terms of dividend, this is where this company's overall dividends as well as price appreciation is where this company stands out. We've got dividend safe to 87%, which is one of the highest. 2.56% in terms of dividend yield, which is quite nice. It looks reasonably valued right now. Credit rate basically A rated, which is strong, and 355 billion market cap. Now the payout ratio for this company is 60%. They have increased that dividend for quite some time, and as you can see, the latest one was the only one that has not been great since I've actually started in this company. So just over 2%, but the last 5 years they've increased that for 10%, which is really good. So if you bought this company 5 years ago, which I actually have, you basically got 10% on top of your money, which is absolutely 10% increase. How often do you get 10% increase with your job? That's absolutely crazy, right? For the last 10 years, I'm sure some of you do, alhamdulillah, but yeah. For the last 10 years, we're looking at about 16%. And as you can see, for 16 years, basically 16 years in a row, they have increased that dividend. And they have not reduced it for 37 years. So some years, they've basically decided not to increase it for obvious reasons. but basically they've never ever reduced it for basically never ever 37 years basically without reducing it. You get $9.20 for every share of this company that you own. So there's a lot more information that we can look at, but I'm just gonna keep basically go to the bits that I want to talk about now, which is basically shares outstanding is declining, sales is basically increasing every single year, return on equity we're absolutely fine, return on equity, return on invested capital about 24%, operating margin of 13%, free cash flow margin of 10%. Now what we're going to do now is I'm going to show you valuation side of it, where the company is. And what I'm going to do is, as you can see, we got adjusted operating earnings growth for this company of about almost a 10%, and the fair value for this company has been 15, basically is 15. Of course, that's what we're normally looking for. And the normal PE, where the market likes to sort of value this company, has been 20. So when we reduce this for to the last 10 years, as you can see, that's 23, and that still stays 15, of course, and then it's about 9%. And the last 5 years we're looking about just up over 2% in terms of the earnings growth rate, which is not great if you think about. But forecast moving forward for this company, we got about almost a 7% plus that basically dividend that we're receiving. Normal PE for this company has been about fair value, sorry, has been 15. And if that happens, basically we'll be losing right now about 6% if you bought the stock right now. But normal PE, when you look at the basically that 20 something percent, also basically you'll be making about 8%. So if you say, I'm going to trust Mr. Market to basically and buy this stock right now, you'll be making about 8% annualized total return. Now what I'm going to show you now is the performance. This is where the bit that I was talking about. So if I click last 15 years, and if I scroll down here, if you invested $10,000 into this company over the last 10 years, you would have made about 16% total return, and that includes basically dividends as well. So compound growth, so dividend growth plus the dividends you would have made. So 10,000 would have become 62,000 and half basically. That's 16% up. The S&P 500, the SPY that tracks the S&P 500, returned basically 12%. That's 41%, 41,000 US dollars. So you basically be in the markets over 4%, which is absolutely amazing. And remember, this company during that period, okay, the average dividend growth rate for this company has been about 18%, whereas the S&P 500 for those 12 years, 13 years, has been about 7%. And according to Morningstar valuation, is $303 per share, is where $5 per share is where they think the price should be. Right now it's about 2 stars. So if it comes down basically another 5-10%, then potentially this company will become attractive again. Right, the second stock we're looking at today is Visa. Visa is another company that has beaten the overall market over the last whatever years. A year to date is actually up about almost basically 8%. For the 1 year, it's about up 25%. For the last 5 years, we're looking at about 86% and so on. Now, Visa is probably one of those companies that are stable, despite the dividends is not huge, but they have been growing their dividends as well nicely. So I'll show you in a second. You could pause this video there if you wanted to see how many strong buys and so on, but it's 10% upside from where we are right now. And if we look at the Visa, for example, dividend perspective, you can see 99% basically safety, which is the highest anybody can get. The yield is not great and looks reasonably valued right now. 600 and almost a 60 billion market cap, AA minus, basically very strong when it comes to credit rating side of things. Now the payout ratio is very low, which means they can increase that dividend anytime they want. 13% basically, 13.5% latest increase, 15% over the last 5 years, 17%, almost 18% over the last 10 years, which is nice to see. 16 years of increase in that dividend. This is what you will get for every share of the company that you own. And the other thing is I want to share with you guys is earnings per share is heading in the right direction. Shares outstanding is declining. Total sales is heading the right direction. Return on equity is probably one of the best. Return on invested capital is same thing. Operating margin of 67% and free cash flow margin of 60%. And the company has very, very little debt, which is nice to see. Now, from looking at Fast Graph, for example, if you put max, for example, you can see the company has been adjusted operating and earnings growth rate of about 20%. Fair value for this company is about 20 multiples, and normal PE has been 27. Now, if we look at for example, last 15 years, that's slightly changed, and for the last 5 years, for example, it's also exactly the same. So it seems very expensive right now. So if you were to buy the stock right now, you'd probably be losing quite a bit of money, about 17% or so. Now, if you look at the forecast for this company using normal estimates, right now, if you bought this stock right now, basically you'll be losing about 15%, which is what we've seen. But for the normal multiples for this company, if you bought it today and you following basically the normal PE for this company, you're basically gaining about 12%, 12.5%. Now let's look at the performance for this company, and we want to look at the last 15 years, like we said early. And as you can see here, the compound growth rate for this company is basically 20.5%. The S&P 500 we've already seen is 12%. Now, if you had invested £10,000 or dollars, whichever, basically about 15 years ago, right now you would have 104,000 US dollars. And this is why I genuinely keep saying to people, you really need to buy things, high quality business, and hold them for a very long time. I do own this company. I think I've had them since 2021 or 2020. I can't remember. I bought more in 2022. Since then, I don't think I bought more because it seems a little bit overvalued. Now, the average dividend growth rate at that time has been almost to 23% for the last 13 years, which is really nice to see. So overall, a great company. I really like the business. Now, according to Morningstar valuation, we're looking at right now $289 per share. It's slightly expensive, so 2 stars right now. So potentially it might come down in the next few months, and potentially will give us a better opportunity to buy this high quality business. I don't think I've ever spoken about Mastercard without talking about Visa and vice versa, literally. And right now, that's exactly what we're going to do. So Mastercard is another company that's done all right, basically year to date. For the 1 year, it's up about 17%. For the last 5 years, we're looking at about 89%, which is very similar to what Visa has done. In terms of moving forward, you can see basically how many people are saying it's strong buy and so on. But it's about 13-14% upside from where we are currently. Now, from dividend side of things, is very similar to Visa, 99%. Low in terms of yield side of things, looks reasonably valued right now. 488 billion market cap, A+ rated when it comes to credit rating side of things. The payout ratio only 19%, which is nice to see. 15% in terms of latest increase, 14.5% when it comes to the last 5 years, almost 19% over the last 10 years. Now 13 years of increasing that dividend, 18 years without reducing. That's what you get for every share that you own. Now a couple of other things, you can see the earnings is heading the right direction. When it comes to shares outstanding, is declining. Total sales is heading the right direction. Return on equity, return on invested capital, both of them absolutely amazing. Operating margins of 58%, of free cash flow margin of 48%, which is nice. Very low debt. Now looking at the basically the company from valuation perspective, as you can see here over the last, if you click history, for example, basically since 2006 where we are, so it's about 23% when it comes to adjusted operating earnings growth rate. When it comes to fair values, it's been 23. Normal PEs has been 30. Now if we reduce that to last 15 years, that's what it's been, and for the last 10 years, that's what it's been. And the last 5 years, okay, we're looking at about 15.5%, 15 PE, and basically fair value and normal PE about 34. Now, if you look at the forecast for this company, if you use basically estimates, you can see here that we will be actually losing about 15%, which is similar to Visa. And if we look at normal PE for basically this company, you know, what the market likes to trade, which is about 38, we will be making about 18.5%. Now, looking at the performance for this company for the last 15 years, if you scroll down, that 10,000 would have given you 108,000. I think these two companies are very, very similar in so many ways. So that 21%, 12% we've seen already the S&P 500. You can see average dividend growth rate for the last 10 years. We're looking at the last 13 years. We're looking at about 37%, which is absolutely amazing against the S&P 500 at 8%. So this is high quality businesses that normally beat the S&P 500, which is quite nice to see in the long run. Just finally, from Morningstar valuation side of things, as you can see here, basically the price, they expect the price to be about 500, just slightly over that. Right now it's about 3 stars, so it's slightly cheaper than the Mastercard according to Morningstar. Right, another company that I own in this portfolio is the S&P Global. This company has reported today, I think, the earnings, and they are basically, they beat both top line, bottom line. I'm not going to go into that. So if you're interested, let me know. Maybe I'll do just full video. A year to date is down about just 1%. For the basically 5 years, we're looking at about 68%. For the last 10 years, 360 percent when it comes to that. Ratings right now is a strong buy. As you can see, basically we've got 16 strong buys there, about 18% upside from where we are. Dividend side of things, we're saying 100, basically almost 100%. The very low dividend yield. Again, a lot of these companies have one thing in common. Because they are dividend growth companies, you're not getting the yield right now, but what you're getting is that compound. Okay, for the next 10 years, basically this is what you will be getting. So about 10% for the next 5 years. If they do the same thing, you're getting 10% basically increase basically for the next 10 years, which is absolutely amazing. Now, in terms of, is a huge company, 150 billion market cap. I'm not sure why they haven't got credit. Who actually do they even have a credit rating? I'll check that in fact in here, because they are credit rating company themselves. So there we go. I don't think it exists, because who's gonna rate this company? That's very interesting, in fact. So yeah, 23% when it comes to payout ratio. When it comes to the latest increase, almost 6%. We've seen the 5 years and 10 years, 51 years of increase in that dividend, which means a dividend king. That's what you will get for every share of this company that you own. Now, looking at earnings growth, it basically is heading in the right direction. Shares outstanding has declined, then gone up, and then it's slightly declined last couple of years. And then sales, basic total sales or revenue side of it, has been heading the right direction. Return on equity about 11%, return on invested capital 9%, operating margins about 41%, free cash flow margin of 39%. Now, when it comes to basically the debt levels is actually quite low. Now, looking since 2005, as you can see, the stock seems overvalued. And you can see what the PE was and the adjusted operating earnings growth rate side of things. Now, I'm going to go straight to forecasting for this one. And if you look at the forecast, and if you buy the stock right now, you'll be about losing about 13%. Yeah, about 13% right now if we look at the normal multiples. And but if we look at the estimates if we look at the normal multiples, which is what Mr. Markey likes to trade this company, we will be gaining about 14%, which is quite nice to see. Now, performance side of things, this is what we're looking for. So again, we need to click 15 years because that's what we're interested. Okay, and £10,000 invested basically about 15 years ago. Right now you would have almost a 20%, or basically $92,000 US. So that 10,000 basically is what would have become. By the way, I'm not even reinvesting. I didn't click this to reinvest the dividend. So that's basically without reinvesting that dividend. If we did the reinvest with the dividend, I think it slightly will be higher, but I'm not going to do that now because I haven't done for the rest of the companies. So 24% when it comes to the last basically 13 years in terms of growth side of things, which is absolutely amazing. Now, looking at the Morningstar valuation, as you can see, $590 per share is where they think the price should be. Right now is $490 according to Refinitiv. Morningstar, sorry, is $540 right now. It's just slightly lower than that. It's 4 stars right now. So it seems basically it's undervalued at the moment, which is quite nice to see for the first time. Next company we're looking at today is Broadcom, and this is probably one of my all-time favorite companies. As you can see here, for 1 year, a year to date is actually down about 17.5%. For the 1 year, it's up about 42%. For the last 5 years, 593%. Last 10 years, we're looking about 1,400% up. A strong buy according to Wall Street right now. 28 strong buys, which is very interesting. 24%, 25% upside from where we are right now. Now, if we look at dividend side of things, 67% safety, 1.23% when it comes to dividend yield, and it seems a little bit overvalued right now. 905 billion market cap, triple B plus a company, moderately strong. Now, when we look at the dividend safe payout ratio, 42%. 11% in terms of growth. This is the bit that I'm interested in. So look at that last 10 years, basically 33%, and last basically 5 years we're looking about almost 14 something percent. Now, this company, believe me or not, when I start buying, it was trading at least about 3% dividend yield up at one point. And of course, basically it has gone up so much since. That's basically what you get every share of this company that you own. Now, in terms of earnings per share, you can see it's heading in the right direction. With regards to shares outstanding, it has declined quite a bit, and then it kind of got up a little bit basically this year. And on total sales, we're looking about over 54 billion basically and this year, and yeah, it's heading the right direction. Return on equity about 15%, return on invested capital 11%, operating margins of 35%, and when it comes to free cash flow margin of 39%. Debt is actually quite low, which is not bad at all. Now using fast graph, we're going to check out the company in terms of valuation side of it. You can see it actually seems right now, if you bought it right now, okay, you probably be making about 18% up if you could basically, if we're using that fair value of 50, basically 31%. Now if we look at the last basically 10 years for this company, you can see it's more or less still seems and overvalued. The bit that I'm interested in, the forecast moving forward for this company using normal estimate, basically, which is about 20. It will be flat basically. If you bought it right now, basically you wouldn't be making any money. And if we look at the normal PE for this one as well, more or less the same, I believe. It's about 3% up from where we are now. So yeah, there's not a lot going on with this, which is interesting. So I would probably say, you know what, it's a little bit maybe overvalued. I would wait for a massive pullback to see if this how this company performs. But according to Morningstar, it's 3 stars right now, $200 per share. I am not touching this company anytime soon. In fact, I'm going to explain in the next video what I did recently on what I'm planning to do with this company, inshallah, moving forward. But like I said, I'm not definitely selling it because it's one of my all-time favorite companies. Now, this should show you that buying high quality businesses and holding them for a very, very long time is probably the game. That's basically where you want to be. Okay. Now, if we look at the last 10 years and we focus on total return here, all 5 companies against the S&P 500, you can see that not only have they beaten them in the last 15 years, but they also did the same thing with the last 10 years. And you can see this is for me the most important thing. When I see this kind of things, of course it doesn't give me an indication of on what's going to happen in the future, but it will give me an idea. It gives me an indication, like if I bought Home Depot, for example, if I hold it for that long, potentially I will be the S&P 500, and that's basically what I'm interested in. So these massive compounders, these companies who've been around for a very long time, potentially will do the same thing. I can't see any of their businesses basically going down anytime soon. Broadcom is the only one that will be very much cyclical. Home Depot is also similar, depending on the economy. You could say all of them are in that boat. If the economy is not doing well, they're not going to do well, right? So please focus on the long term. Again, I'm not going to show you how much of these companies I own right now because I'm going to do a portfolio update, inshallah, in the next couple of days. Then you can watch that, inshallah. If you have not joined us at the Patreon account to support the channel, please do so, and also join the free Discord, which will the link. I'm going to update the link. It hasn't been working last couple of days, so I'm going to update after this video. So inshallah, so yeah, join us in this journey, inshallah. Have a wonderful day. Assalamu Alaikum.